intraday, it does it on a longer term time frame, and it also does it on a macro time frame. So if we have a correction and we know that an impulse will follow a correction, what we want to try and do then is understand how and when a correction will unfold, how and when a correction will complete, and if an impulse is to always follow a correction, which it does, then if we can identify its probable completion, then we put ourselves in a much better position to trade the impulse that follows along very nicely. And of course, obviously the one thing we want to do without fail is trade that impulse higher. So tonight our goals are to look at corrections, understand how it will unfold. We're going to be looking at 4 different kinds of corrections. We want to try and identify its probable completion. When do we label an impulse move as a major degree wave 1 versus a intermediate or smaller degree wave 1? Well, that would depend on the size of the wave or compared to the prior wave. If the prior wave is a very late 10 days to unfold, the important thing money is movements in an impulse, and as I've said before, wave pattern at the lows. So you can see in that which wave is in bar, wave E, so you'll tend to have a zigzag in the wave 2 position. You'll tend to have a flat pattern in the wave 4 position. You will tend to have a running flat in either the wave 2 or 4. Sometimes it can be in the 2 position, and usually the triangle 99 times out of 100 will be in the wave 4 position. In fact, you cannot have a triangle in the wave 2 position. That is against the guidelines of Elliot waves. So if ever you see a triangle, you have to assume that it's actually in the wave 2 position, or it's a more complex pattern in a wave B position rather than inside an impulse. Okay, we're going to start talking about Fibonacci retracements. We're going to be talking about external and alternate projections. This is where people can get caught up in analysis paralysis. Don't get too caught up on the measurements. At the end, I'm going to show you a summary of all the measurements, and I'm going to give you a spreadsheet that you can have a look at that has all those things on it. So Fibonacci retracements, external projections, and alternate projections as well. So let's start with retracements. At the Chartist, we only ever use 3 retracements. The retracements we use are a 38.2%, a 50%, and a 61.8%. That is it. We don't use anything more. A retracement is we have an impulsive move, and then we have a retracement back against that move of some degree. Usually in the wave 2 position, that degree of retracement will be quite deep, usually 61.8% or 50% to 61.8%. In a wave 4 position, it will be a lot more shallow because a lot more people are comfortable with the trend. They do not allow it to dip as far, and usually in the wave 4 position, the retracement will be 38.2% to 50%. In a downtrend, the same rules apply. So we have an impulsive move down, then we have retracement back up, and then usually an impulse will follow that. And again, we use the same rules, 38.2%, 50%, and 61.8%. We do not deviate from those kinds of levels. And that's a good example of what we can expect in a retracement. So impulse, retracement is the blue line, 50% and 61.8%. As I said, usually when the trend is very early on in the piece, we'll get a 61.8%. When the trend is mature, everyone's on board, they all understand what's going on, they understand it's an uptrend, it's not silly, and they will not allow the market to retrace as far as what the non-believers will allow back here in a wave 2 position. Now here's a good example of the kinds of retracements we can pull out of software. As you can see, they're completely and utterly useless. Everybody has their own. There are Gann retracements, there's harmonic retracements, there's Fibonacci retracements. I guess if you have enough retracements on the chart, you'll get it right, but at the end of the day, we simply don't know which one is going to stop. So we use very, very simple rules at the Chartist. In a wave 2 position, we always look for a retracement that's going to move 50% to 61.8%. That's it. Nothing else. It doesn't have to be spot on, it doesn't have to be perfect, but that's the kind of area we're looking for a wave 2 to terminate. In a wave 4 position, we're looking for a wave 4 to terminate in the 38.2% to the 50% zone. in that kind of area. And the justification is in a wave 2, it's deeper, in a wave 4, it's shallower. That's all there is to it. Let's talk about external projections. Now, we're not going to be projecting Fibonacci out of the correction. We're actually going to be projecting it inside the correction itself. So when I talk about that, basically what we're looking to do here is look for a terminal point of wave B. So we have an impulse up, we've got a wave A, we've got a wave B. Now what we're looking for is the correction down to wave C. So we measure the length of wave A, but then we project it out from the wave B of that point. So usually that is a 1-to-1 ratio. Another way we can do it is we take this distance here and we project that out by a certain percentage as well. And what that will do is give us a cluster points down here. So just bear with me with this. We can take this distance down here and project it from the wave B high by a certain percent. Usually it's 1-to-1. Or we can take this distance and project it by this distance by a certain percentage, usually 50%, and we'll get a wave C terminal point. That is called an external projection. Now, an external projection is when we extend outside of the wave we're talking about. The wave we're talking about here is this wave A right here. We're extending outside of that. All right, not internally, we're extending outside of that. And that's why it's called an external projection. This is the other one. We take the length of wave A and we extend it out. Wave A, extend out, usually 50% or 100% off this wave B high. But that's an external projection. So we can extend it off the wave B, or we can extend it off the end of wave A. The more we extend it off different points at different levels, the more of a cluster we're going to get down here. Now you can go to the nth degree, you can do it off here, you can do it off there, you can do it off wherever you want to do it off, but ultimately we're going to get a cluster point down here that's going to be the wave C. So an alternate projection is slightly different. We're actually taking the wave B, which is an internal movement. Here's the wave A, here's the wave B. That's internal. We're taking the distance of wave B and we're extending it outward again. And usually we're extended out by 1.5 to 1.618%, and that'll get us a wave C projection down here. So this is an alternate price projection. Alternate meaning that's an internal wave. We're extending it outwards from that internal wave. So really what I'm coming to here is we want to take a retracement Fibonacci level, an external projection, and an alternate projection, and what we finish up with is a cluster of projection points and retracement points, and that is the good point at which a wave C will tend to terminate at. So let's have a look in a more diagrammatic version here. So we've got this impulse and we're looking for a retracement of this impulse. This is the wave A and we're looking for what's called an external projection of that particular pattern or that movement downwards again. And here you can see this is an alternate projection. So this goes against the grain and we're looking for an extension downwards against that, the alternate. And what that will give us is a cluster point at this lower level down here. So impulse A, B and C, this is what we're trying to figure out where the complete correction will terminate, and that will give us a good buying point. And the more of these projections and external retracements we can get, the better idea we can get at this point for a buying opportunity. So let's have a look here. We've got a 5-wave impulse off these February lows. 1, 2, 3, 4, 5. Up we go. Impulse to an A, up to a B. Now at this point right here we want to start asking the question, where will wave C terminate? So what I've done is I've color coded everything here. So on the green line going up, with 61.8% retracement of the green line, okay? So that's a 61.8% retracement of the prior impulse. That comes in right there. The external projection is this move times 1.618. So this move multiplied by 1.618 subtracted from wave A takes us down here. And the alternate is this move here multiplied by 1.618 off that low gives us that low there. So you can see we've got this cluster down here, and you see how it's all 61.8% levels. It's not an exact science to the cent, but you can see only one bar came into this real cluster zone before we started heading higher again. So A, B, C, here's our target area. Do we have a bullish bar at this point of time? Yes, we do. Do we have bullish volume at this point of time? Well, I haven't put it on this chart. Maybe we do, maybe we don't. Are there any other indicators right here that are saying that support is in at these levels and that a movement higher will occur? Well, I guess you can look across to the left here. We've got these old highs. Look at that. We've got 1, 2. We've got 2 old highs here, which is resistance. Back to support. Remember, old resistance becomes new support. So we've broken up, come back, bang, off we go again, and it just happens to fit into that cluster zone. Other question here is the purple external. The question is, was that from the top of wave B? No, it's not. It's an external projection, which means we've taken this line and projected at 1.618% straight down. So it's not from up there. That is usually a 100% projection. I haven't done it on this just to keep it clear. So we take this high, wave A, and we project that distance off the wave A low by 1.618%, and we get that low right there. Just to reiterate that, we take this length, we multiply it by 1.618, and subtract it from that level, and that gives us that level right there. Remember also we can use the one-to-one, so we take this distance, subtract that distance exactly, and it'll give us a measurement probably around this kind of area. That's the one we tend to use more often than not. Can retracements and projections surpass the 61.8 to get the cluster area, or is this the maximum? I'll come to that. I mean, there's lots of different measurements we tend to use, but usually we want to stick to the major ones, okay? The more you find yourself going out onto a limb, going, oh gosh, you know, that's a 78.6 and blah, 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 then the more you're pushing your luck. What you're trying to do in that situation is you're trying to fit the correction to what you want to happen. You understand what I'm saying? We don't want to push a pattern into the chart. We want the chart to tell us what the pattern is without trying to push a pattern onto it. It's very important to think about what is the chart telling us as opposed to, gee, what do I want the chart to tell me? Two very, very different things. And that's why we only ever use the very specific kinds of levels, i.e. the 61.8, the 50%, and the 38.2, and projections there wrong. Alright, so here's another one. We've got an ABC correction and a bigger corrective move. You can see this is bigger corrective move going up to A, B, and C. So our retracement of the correction, so this move up here, all the way back down, that's 61.8%. The alternate price projection is 1.5%, so this movement up here, extended lower, is 1.5 or 50%. And then the movement down to wave A, external price projection is 38.2%. So we've got this cluster down here. Didn't quite get there, but look, a nice high close. Tag that zone, nice high close, and go straight off again. Remember what I said, when prices hit that zone, we've got to take note of what bar or what's happening. You can see here, very high close. Look at the bar before. Probe down, high close, probe down again, and another high close. There's good buy demand coming in right here, and off we go straight up again. So it's hit the cluster zone, a little bit more complex kind of pattern here without a doubt, but that's exactly what happens. And let's look at a bearish version here. So we go down the impulse, A, B, C, back up, and a nice cluster zone here. So the retracement from this high down, 50% retracement. The external retracement is exactly 1-for-1. That's what I'm talking about. So that distance added on to that gives you 1-to-1. Now that's the normal one we look at in the chartist, okay? Where wave A equals wave C. We're looking for symmetry, wave C being the same length as wave A. And I'm sure if we did a external price extension, we'd get a 38.2% tag out area as well. So there's many ways you can do it, and the alternate is 1.382%. So we take this distance multiplied out by 1.382%. So you will always get a cluster zone in this region, and the tighter it becomes, this cluster zone, the more positive one can get from the move lower. So here we've got a high close on that particular bar, but look at the next day, bang, low close. So that's your entry bar right there, selling a break of that low there, place a stop above that high, and away you go into the next trend low. So that's a good ABC pattern in a downtrend. Here we have a flat pattern. Now the key thing with a flat pattern is wave C will always terminate at wave A, pretty well spot on, and that's what's happened right here. Not a good bar for that to occur. You can see we've got this big wide-ranging bar, but we even have some measured moves up and around this wave C area. The external price retracement is 1-to-1. That is, this wave right here is exactly the same length as that wave right there, and we also have a retracement of this move down, back up 50%. But the more important thing with the flat pattern is that wave C terminates at or near this kind of wave A high. The key element is this high has not been penetrated, so you would have been stopped out if you held on to a short position after entering on this bar right here. Time is an interesting one. It's something that we are trying to introduce a little bit more of. It can be very cumbersome unless you've got the software to calculate it for you. AmiBroker, and I will show you the AmiBroker software very shortly how it does it. There are a couple of other software packages that do it as well. Dynamic Trader by Robert Miner, which is, I don't have it, but Pete Hammersley, who does our ASX chart research, he uses Dynamic Trader. It does time projections very, very nicely. The Robert Miner book is a very, very good book for this kind of stuff. It's very practical, hands-on material, and I would strongly suggest that if you're interested in taking this further, that book is the way to go. Dynamic Trading by Robert Miner. He has 2 books out now. Dynamic Trading is his first book. It's a hardcover book. I haven't read his second one. I know Pete Hammersley has studied both of them in depth. So basically what we want to do is time is just a third dimension. We do not forego our Fibonacci retracements, our projections or our alternate projections, but we can add time in there as well. So if we have a look at this particular chart right here, we see an impulse down, we see a low point right here, and what we're doing is we're taking the time traveled from the absolute high to the absolute low of this impulse, and we're extending it out. And you can see right here that very, very close to a 50% extension, and we have a high point there at wave C. So A, B and C. Remember, it's not an exact science. Don't get hung up on this exact science kind of stuff. A day here, a day there, but at the end of the day, you can see we've got some very good symmetry in this ABC from a price perspective, and we also have very, very good symmetry from a time perspective. And when it all meets up, again, it's just another level to be confident of to take a position. So we measure the move down in terms of business day, not in calendar days, and measure the move back up in business days, not in calendar days, and we get this time extension. Alright, it's exactly the same, and again we use the exact same measurements as we do for price retracements. So we're using 38.2%, we're using 50%, and we're using 61.8%. Right, they're the key 3 retracement levels in both time and price. Here's another one. We've got a move up, ABC, correction, and to the day, 61.8% in terms of time. Now, it'd be quite interesting to see how that extended out or that transformed in terms of price. It's a pretty shallow kind of correction. It looks like a 38.2%, but it would be quite interesting to see what the actual price retracements were on this, because the time projections are exactly spot on, and off we go again to the upside. And again, note this bar right here, you can see it behind the blue line, very high close. So again, just from a time perspective, very, very bullish signal right there. You can use the trader's trick entry, entering a buy above that high and a stop loss below there gives you a very low risk entry, and off you go to the upside there. You take a low point, you take a high point, and then you extend it out by Fibonacci level. In fact, while we're on that, let me just bring up AMI Broker so I can show you. This is the XAO. So let's go back and find ourselves some kind of corrective movement. Here we go, here's a nice, what pattern is this one, everybody? Got a high point, down, 3 waves up, and back again. That pattern right there is a running flat. See how wave B runs against that high, wave C runs below the wave A, and then we have a running flat. Now let's just have a look at a time projection. So when we do the time projection, we go Fibonacci, we go extensions, Fibonacci timeline, so there. Okay, so there's a 100% line, that thick line right there. We missed by about 5 days. It's a 100% line. So not too bad. Retracements. Now it looks like a 38.2% retracement. So again, we're going to take it off that low. So you can see here's our cluster right there. We've got a flat pattern. It's going to be a shallow pattern. There's our 38.2%. That's typical. There's our 100% time. Typically, I mean, it's not too far out, but you can see what I'm talking about. You get a cluster in this particular point. Here's another running flat pattern. Let's have a look at that in terms of time. Insert Fibonacci time extensions. And okay, so what we've got is an impulse high A, B, C. We're out by just a couple of days right there. So that gives you a good idea. Let's insert the Fibonacci retracements. This one's going to be a little bit difficult. Okay, so that's a fair way out, that one right there. But in terms of our typical rules, you can see that the wave C has terminated just below the wave A, and that's the more important thing. And more importantly, notice that we've got a very high close in that particular point right there. So that's the more important pattern. So A, B, and C, where C terminates just below, we're at wave A low right there. Oh, here's one here. Let's have a look at this one right here. So firstly, let's try the Fibonacci retracements off this low. Okay, so we've got an A, B, C. Look at that tag into 50%. Perfect. Now let's insert our Fibonacci time. So off the low to the high. Oh, look at that. Look at that. Let me just come across here. All right. Can everyone see that? So we've got impulse up, A, B, C is our 50% retracement in terms of price, and we're out by 1 day on our time. So the impulse up 100 and retracement down out by 1 day. So there's a good example of time and price relationship meeting pretty well perfectly. You're never going to get absolutely perfect, and if you look for perfect, you're going to be sitting here for a long time, and you can see prices just zipped on higher. So see that cluster right there? That's what I'm talking about, where price and time all meet at the exact same point, and away we go. There's your A, there's your B, and there's your C. Okay, simple as that. Impulse A, B, C, off we go. And remember, all our measurements are being met here. Remember, in a wave 2 position, we're looking for a retracement to the 50% to 61.8%, and there's the 50% tag exactly right there. We're going to be looking at volume. Now, volume we could spend 2 hours on its own. So what I want to do is just have a look at a few different things for you to keep an eye on. Now, the first thing I want you to understand is the volume histogram at the bottom of this particular chart. Some of you will be aware of this. This is something I've used for many, many years. Our black histogram is the volume. The red line is a 10-day moving average of volume. Okay, so that gives us the trend of volume. You can see here the trend of volume is increasing, decreasing and flat, increasing, decreasing. So the red line is a 10-day moving average of volume. The cyan line is a 2 standard deviation of the 20-day moving average of volume. Let me repeat that. The cyan line is the 2 standard deviation of 20-day average volume. What we're looking for in that particular situation is extreme volume. Alright, extreme volume. Whenever we see a move of volume above that cyan line, we have to ask the question, what is happening here? What is going on? So what I want you to keep an eye out here is what we call volume bubbles. That's when volume expands and contracts very, very quickly. And a lot of the time you'll see volume bubbles occur at absolute low and high points. Have a look at this low down here. You can see volume expands and drops back down again. Volume expands and drops back down, expands and drops back down. But have a look where it's all occurred. It's all occurred more or less at the same price. And what's going on here is people, i.e. smart money, obviously think this particular stock is a pretty good buy at $30. And as I've said many, many times before with volume, the way these analysts work and the way these fund managers work and their analysts that work for fund managers, they'll say, you know, if stock XYZ gets down to around $30, it's a great fundamental buy. It's a good value proposition. They're not saying at $30 exactly. They're saying if it gets around that level. And that's what happens right here. Prices come down, hits $30, and all these fund managers jump in and go, right, our analysts think it's a good buy in and around this place, and they start accumulating the stock down here. And that's why volume jumps, because these buyers come in and start accumulating the stock, goes up again, comes down, bang, in it comes again, we'll start accumulating, and one more time. They're not trying to pick the absolute low, they're trying to pick value, and that's exactly why these footprints are left in the volume. And this is very, very important to get a grasp of the volume, especially when we're talking about trying to determine the end of a correction move, because you will get these volume footsteps coming in and we will understand exactly when the correction will terminate. There's other ways we can do it using divergences and other kinds of patterns as well, but support, resistance and volume are very, very important in determining the ends of corrections. Here's another example right here. So we've got an A, B, C pattern. This follows on for an impulse, A, B, C. Have a look at this big volume spike down here, this bubble, volume bubble on this initial retracement. So buyers are coming in. Have a look at this bar right here, down, high close, another close off the lows. So there's buyers coming in, volume is very high. Now have a look what happens. You can see volume drifts lower again as this secondary retest, which means there's not a great deal of selling interest going on right here. But we're coming back into this area right here. Not a great deal of selling interest. In other words, the buyers don't have to do that much work again. So this is called a retest, and it potentially becomes a very, very bullish proposition when you see a retest on very, very low volume, which it is right here. You can see it's below average volume in these low points, and that just means there's absolutely no seller supply coming into the market, and that's a bullish proposition. Here's a triangle, and again it's very important to understand that during a triangle we've got 5 internal swing points. They must all coil as they do right here, and volume in general is drifting lower. But have a look at each one of the low points. Each one of the low points has an increase in volume, albeit for a day or so. So it looks like there's a line or so, the contracting of wave 1 and an outside chance of a 78.6% retracement of wave 1. In terms of time, a wave 2, the minimum time is 62% of wave 1 and the maximum time is 162% of wave 1. In terms of wave 4, we're looking for 100% of wave 2, 38.2% of wave 3 to 50% of wave 3, 38.2% of extension wave 1 through 3, and a 50% extension of waves 1 through 3. In terms of time, we're looking for a greater length of wave 2. It cannot be shorter than wave 2, and a maximum length cannot exceed wave 3. Now, this is already in the secure area. You can download it in the resource library whenever you like. Understand at the bottom here there's a bullish page and a bearish page. So if you're looking at a bullish impulse, you've got to go to the bullish page. If you're looking at a bearish impulse, you've got to go to the bearish page. One other thing, the time analysis does need an add-in if there's some kind of decline and $3.37.